You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Jerry Parker and me, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Now, for those of you who are regular listeners, our conversations are intended for you to learn and grow as rules-based investors. And if you're new to the show, we hope that today's episode will trigger your curiosity to check back the catalog and listen to past episodes that you may have missed, like last week's episode with Harry, where we discussed how investors can best protect their portfolios against 3 different types of equity market drawdowns using trend following and volatility strategies, which I encourage you to go and check out if you missed it, not least because Harry's is great at explaining some of these complex issues in a very clear and straightforward way. Just like you, Jerry, how are you doing? Good to have you back today.
Hey, Niels. Good to see you. Glad to be here. Thanks for having me. I'm doing well. It's 10 a.m. Eastern, so versus our usual 7 a.m. So I'm ready to go. You don't know what you're going to get today because you don't have me all tired and trying to stay awake by the coffee. So, which, by the way, is in a big uptrend. So I'm happy about that.
Yeah, by the way, that is true. Yeah, no, it'll be exciting to see you on the loose, so to speak. For all of you listening, as I often say, if you love the podcast, please get someone else to listen. We certainly appreciate your support. Now, today, Jerry and I, we, as mentioned, are recording a little bit early, a day earlier than normal. So just so you know, again, to reiterate, if you think we're missing out something, big event that happens after our recording, you know why. Now, in terms of a quick summary for the week, and given that it is a quiet week so far, I don't have the usual details that I normally have. But to me, there is one standout sector maybe for the week, and that's energies. We have seen a bit of pressure on prices against the longer-term uptrends that most trend followers will be holding. Maybe this is related to the news headlines that the U.S. is selling 20 million barrels of crude oil from their strategic reserves, but I think most people may have forgotten that that's actually old news because it was first reported back in August. But in any event, it has been a soft week for energies. Crypto and Bitcoin actually, and Ether, so crypto in general, but Bitcoin and Ether in particular, has also had a soft week, down 15-20% on the week, which of course has happened many times before. But the beneficiary so far this week at least seems to have been things like volatility, if you're long, but also the US dollar. It's broken out of its range that's been stuck there for a while. So that's kind of exciting to watch and see what happens next. But I want to know from you, Jerry, what has been standing out to you since you were last on a few weeks ago, either market-wise, performance-wise, anything?
Well, since the last time I was on in the past few weeks, we've definitely seen the strengthening of the dollar, and today it's, I think, making new highs against the euro. So I held on to those currencies, those short currencies, most of them, and so I'm being rewarded today and recently for hanging in there with those short currencies, long dollar. It's been pretty choppy for me and discouraging on these interest rates. The whole world talks about inflation and higher rates, and we see a down move in the bonds and then a big rally a few days later. So that's kind of been sort of choppy for me, and give backs also in LME and energy, like you said, big give backs in natural gas. I trade both of those natural gases. So it was a real big come down. I talked bad about take profits or vol targeting, but it was certainly it worked better in that UK nat gas. But of course, we're still seeing good trends in some of the softs like sugar, coffee doing really well. And I guess material part of my portfolio is Bitcoin, and that's the euphoria at 66,000, and now it's been selling off. So a lot of pluses and minuses this month.
Yeah, definitely a few corrections here and there. And so, I mean, overall, it looks like things are generally flat, at least if I look at our portfolio for the last, for this month so far, it's pretty flat in terms of our returns. So we'll see how it all transpires. In terms of our volatility strategy, same thing, same picture, down a fraction for the month, but it's been a really quiet period for our approach, at least, even though volatility as a market, or the VIX as a market, has been reasonably volatile. So we'll see how it all goes. For my own trend following portfolio, obviously these numbers are as of Thursday and not Friday as we normally do. But it's also flat for the month. It's still up 8% for the year. Performance so far this month breaks down in terms of groups. Group 1, classical trend, up 69 basis points. Group 2, long bias trend following, down 2.34. And Group 3 are these fast reacting models, that is up 1.62%. In terms of sector attributions, best sectors are really equities and softs, and the worst are energies, currencies, and base metals. And if we drill down to the single markets, DAX, NASDAQ, and the Euro are the top 3. And then at the bottom, we find Canadian dollar, heating oil, and crude oil. If I look at the exposure in the portfolio, it's still mostly long the most markets. There are a few shorts like the Euro, the Yen, and the US 10-year notes. And in terms of the risk to stop level, it's come down this week. It's down to 7.91%. Last week, it was 10.93%. So a little bit tightening up in terms of the stops and maybe a few exits during the week. Now, Jerry, we're going to jump in some questions. You brought along some tweets we're going to talk about. I have an article which was a profile of one of our peers in our industry. So there's lots of things we can talk about. But the first question I want to get to is from Robert. Robert has been writing this he wrote it in a little while ago, but because last time you were on, we did the quiz, the turtle quiz, we have been, haven't been able to get to this. So I appreciate, Robert, your patience on this one. Robert writes, still listening to your podcast, my weekly companion to remind me to stick to the rules. I have a question for Jerry Parker, if that's okay. Jerry often mentions that he has single stocks in his portfolios. In the last podcast, he mentioned Moderna and Tesla. Great examples, but given that these are big winners, there must also be losers. And this made me wonder about the selection criteria and selection universe. In terms of universe, can you quickly graduate from the 30 stocks in the Dow Jones to the S&P 500 and then to the Russell 3000? That's a lot of reasonably liquid stocks to choose from, and Tesla started its stellar run long before it joined the S&P 500. One possibility would be to take the S&P as a selection universe and then successfully take signals until your allocation to this strategy has been filled, let's say 20% of your equity. Respecting these 20% after this point, new positions can only be opened once old ones are closed. To be fully rules-based, one would also have to be able to rank entry signals once they simultaneously exceed the number of quote-unquote open slots in the strategy, assuming that we are working with end-of-day data. So if Jerry could provide a general idea of how he approaches this, that would be great. I'm assuming that there is a rule of sorts. Otherwise, we would be falling into the discretionary camp, which is very opposite of what trend following is about. Thanks again, and thanks for a great show, and continued good luck. Thanks so much, Robert from Lisbon. So, Jerry, how do you find these stocks?
Yeah, there is a systematic process of sorts. Thanks for that. Of sorts, I think it's important to remember that I want a fixed universe. So I don't want to change, the markets I trade. Have them in, kick them out. If something hasn't done well, I'll get rid of it. But then if it starts doing well, I'll get it back in. So I don't do that. I think for CTAs, it can be quite paralyzing to, the markets, the futures markets give us, a fair amount of currencies, commodities, and interest rates to trade. We just trade them, and it's almost like the exchanges are dictating to us what we're going to trade, and we're happy with that. And in stock indices as well, there's 20 of each, or maybe 50 commodities, something like that, and we choose the ones we like and that are liquid. Oh, now I have 5,000 stocks to choose from. What am I going to do? Then I'm going to ignore it, and I'm going to trade the indices. So not me. But I still can get a little paralyzed. How, given all of this freedom that I'm going to take, that others may not. How do I get down to my 30 some stocks? And just like all the other markets, I think the right approach is base your selection criteria on diversification. Get a group of stocks that are not so correlated to each other. And then if someone's going to say, well, what about last February when everything was correlated? All the stocks went down. Then I'd say, yeah, that's a bummer. We are faced with that. But you know what? All the other markets went down as well. So sometimes all the stocks behave the same, and sometimes all the markets behave the same, and we lose money. But anyways, most of the time, they go back to, we'll see some meaningful diversification. So he's exactly right. I chose Moderna, Tesla, others, Bitcoin, but strictly because it added diversification to my portfolio. And by my analysis, the stocks that I chose were not so correlated to each other or the S&P. Now, unfortunately, I did hit on those big ones and a couple more. But as you can anticipate, not only did some of my other stocks not do as well, they didn't make hardly any money at all. They're shorts now. And so I'm not that happy that as the S&P makes all-time highs and the NASDAQ and the Dow, I've got a couple of big winners, but also have quite a few stocks that are dramatically underperforming. Beyond Meat, Canopy Growth, DraftKings. These are what I would consider to be weird, different, single industry, a single product, something that might give me, they're not going to be that correlated to other stocks, and they're going to give me maybe an edge as it relates to finding an outlier. But then, of course, if they're not going to look like the S&P, I'm going to have to suck it up when Beyond Meat's a short. Canopy Growth, which is marijuana, it's a short. DraftKings is becoming a short. So, this is the way we sort of choose to do life. Maybe the dollar is headed for a big rally, a huge monster run. And my longs in the ruble and the shekel will turn into losses. But I'm happy that right now that I have meaningful diversification. I have longs and shorts in the currencies. I'd like to have more shorts in the commodities. So I can't really complain that I have some longs and shorts in the stocks.
So let me bring up just something that I thought about as you were speaking there, Jerry. So one of the things that I think we tend to say as an industry is that, we obviously love direction, we love volatility, but actually what we kind of really like is divergence in our portfolio. We want markets to do something more or less independently rather than just being highly correlated. That imposes a lot of risk in the portfolio. And so I think if you think about it that way, then I think it makes perfect sense to have individual stocks rather than the indices, because as you rightly say, I mean, sure, the equity indices are making new highs, but they're all making new highs pretty much, maybe with the exception of Japan and Hong Kong, but generally speaking, so they tend to be incredibly correlated. So if you want this divergence, so to speak, then having individual names in the portfolios makes a lot of sense, I think. The question will be, of course, well, maybe should I blend my equity total exposure with a little bit of the indices and a little bit of, and maybe a majority of individual names to again get a mix and maybe some benefit from sometimes when the indices move perhaps in a fashion where they're easier to hold on to, potentially. I don't know, never looked at it. But in general, I think what Robert's question gets to is just market selection in general. And I think this is one area of trend following that has subjective measures. That's we choose markets because with some level of discretion, meaning that we don't have hard and fast rules to say, yeah, I have to trade these markets. It's just simply not there. So I think that's where the main discretionary part of what we do comes into, because that's part of our research. Which markets do we want to trade?
Yeah, and I think it's diversification and liquidity, and then the number, I guess. And there's two. I think you're bringing up two different types of divergence. One is I'm long the ruble and short the euro,
right?
And then the other kind is divergent trading versus convergent. So what's going to give me a good chance for an outlier? So I don't like to trade big conglomerates because they have too many businesses going on. I want to a new company or a company that hasn't diversified itself yet. It's only involved in, vegetarian meat, Beyond Meat, or DraftKings, or electric cars. And at some point in time, if they diversify too much, you may say, okay, I'm going to kick that out. And kicking things out, I think, permanently, and adding things that add, I've been adding lots of markets over the past few years. That's good. But other than that, we want this fixed universe so we can apply the systems consistently to the same markets over time.
Yeah, and for me, when I use the word divergence, because I think you're absolutely right that can actually be used in different ways. For me, divergence in this sense is really just finding markets that are independent of each other, really, rather than too highly correlated. It's not so much whether we are long or short one or the other at any given point in time. It's just that, generally speaking, the ruble and the Australian dollars, they will probably not be affected by the same thing. So they are more independent than maybe the euro and the Swiss franc will be, to make an extreme example there. So that's what I mean. And I think this is what we love to find and what we love to see in the portfolios. And this is another thing that we'll come to maybe later. And this is just this thing about, inflation, because I do think, generally speaking, that markets tend to become a little bit more loose or divergent, so to speak. When inflation comes into play, they react a little bit different, compared to when central banks have a really hard control level. Anyways, that's a different point. I want to get to a question from Brian. Hey, Brian, thanks for also your patience, because I know you wrote in a little while ago. But this was also for Jerry, so we stay with the single stock model. Brian writes, for Jerry's single stock model, how do you treat dividends? Are they absorbed into fund balance or reinvested into the current positions?
Good question. I think Brian asked me this question recently in Clubhouse.
Okay.
But I wanted just to make one final comment on the point you made. You made a good point. And I try to categorize these stocks, I want some stocks that are, they're commodity related,
Mm-hmm.
I can't get commodity exposure. I can't get exposure in lithium or uranium. So I'm going to find a stock, hopefully, that will give me that market. I want something that doesn't have a lot of one single business, weird stocks like Beyond Meat, Canopy Growth. And then I thought, just like you were saying, in order to maintain the maximum divergence and asymmetry that you lose in an index, sometimes what's going to carry the day is kind of like earnings, who's earning a lot of money. And so I thought, hey, I know what I can do. If I really want to kind of have my cake and eat it too, and mimic the S&P or the CAC 40 or the DAX, I'll choose a couple of those stocks from those indices that are highly weighted. So I can get most of the S&P with Microsoft, Apple, and Google. And then whatever the other indices, the CAC 40, it's probably one or two stocks that is going to give me most of the CAC 40. So I'm getting that similarity, because we all don't want to venture too far off, from our peers and step out and get smacked. But then again, I'm not compromising my beliefs of trying to get away from these indices and apply those systems to each individual market and not a conglomeration, really something that doesn't exist. So, but on the dividends, I don't change my position when I get a dividend. I sort of include it into my income, like interest income.
Yeah.
However, I have to adjust my data to take into consideration dividends. So from the future side, we're going to have the continuous contracts and those decisions and those rules, trying to be consistent as possible. And then on the stock side, it's probably a bit more complicated than a continuous contract, especially for all of us who are new to the stock world. But having your data provider, CSI in our case, to include those dividends and adjust that price, I think is the way to stay consistent in a legitimate data series.
Yeah. Brian goes on to say, do they impact performance? Obviously, the dividends we're talking about here. For my system, I immediately reinvest any dividends into new shares of the same stock. I look at it as similar to rolling futures positions. Does Jerry approve this approach for one of his cockroaches?
I approve of that approach. And once again, I have my position set on day of entry using the ATR, unit size, and it's sacrosanct. Unless I get a big addition, new client addition or client redemption, I'm never going to change that position based upon anything else.
Good. Excellent. Well, thanks for the questions. Thanks for the patience. As always, you can always send them in, info@toptradersunplugged.com. That's where they should be sent to. Now, Jerry, you brought along a few tweets, some of them related to some articles that we can dive into. So I'm not too sure exactly where we're going to go with this, but so that makes it even more exciting. But the first one I picked was from a New York Times article called Risk-Return Trade-Off Is Phony. I think it may be related to a new book. Do you want to take it from here?
Yeah, it's funny because that's my favorite, my first one I brought up as well. So I like this article. I like finding things that I can agree with from the New York Times. I feel like it gives me like this instant credibility. So I love this article, and it's an article from the guys Spitznagel from Universa, and the guys who made thousands of percent with their tail risk strategy, Taleb. And I am able to cherry pick and pull out a few sentences and twist it into supporting my beliefs about trend following, even though I don't think he's much of a trend follower necessarily, or anyone who's interested in diversification, the way we practice diversification. But the first quote is, conventional wisdom in investing says that there's a trade-off between risk and return. To make a lot of money, you must take the chance of big losses. Play it safe, and you'll most likely have to settle for meager returns. And then I say, he sort of says maybe reducing risk actually increases returns. And so what he's saying is, take care of those losses. Don't let a loss devastate your portfolio. And you can, from our point of view, we believe that totally. We take lots of positions. We spread it out. We do shorts, lots of different sectors and markets. And we don't put our portfolio in a situation where we're going to have a chance for a big loss, because I would define loss as a loss of capital, taking a big loss. I risk 25 basis points per trade, thereabouts. And of course, a drawdown from a hugely profitable trade, I don't necessarily pay too much attention to that, and I wouldn't classify it as a loss. But I'm in a minority on that. But what he's sort of getting at, maybe reducing risk actually increases returns, is the whole idea of compounding and needing to make, as we lose money, we need to make more money to cover those losses. If you're down to 50%, you have to make 100% to get back to even. So these losses can have bigger impacts on that part of the compounding part of our returns. And so sometimes actually reducing risk, you can get ahead of the game better than concentrated bets that, yes, they can pay off, but they can also put a big ding in your portfolio.
Yeah, I mean, it is certainly a topic that is something we come across quite often, and I think it's. We talked about Moderna earlier today, and now we're talking about these things. What people like and what they should do in terms of risk and return, and so on and so forth. And it kind of reminds me of this sort of story that one of the previous guests, Professor Andrew Lowe of MIT, talked about, where he, when he does a big speaking engagement, he always starts by asking the group of people listening to him about 4 different equity curves and which equity curve they would choose. And there's like one which is really kind of just moving up very slowly but very steadily. There's one which is more like a 45-degree, very stable and pretty good. And then there are a couple of more volatile ones which end up making more money, but you don't know what they are and you don't know which period you're looking at. And it was quite funny because, of course, the one that people choose is like the 45-degree, hardly any volatility, and it just goes up to the right-hand side. But then when he tells people what it is, so the low return but super steady is U.S. Treasury bonds, of course, or short-term interest rates. And then one that people never pick, which is volatile but is actually pretty good, is the S&P, which of course everybody loves today, but this was a different period. And then the one they also don't pick, which has really good returns, and is actually Pfizer. And it's funny that he chose Pfizer. I think if you did that today, of course, the chart would look very different. So that's what it was reminding me. And of course, the one they choose is Bernie Madoff, right? It's the one that is steady
right.
Eddie. But they just don't know that the period only goes up to just before he blows up. But I mean, the whole risk-return debate is very interesting.
I think Richard got me onto this idea recently. I'm always putting words into his mouth, but you kind of want this volatility. You kind of want, in order to get the asymmetry, the maximum asymmetry in this profitable trade, the possibility of loss is no longer there. You know, cutting back on the vol targeting or whatever, portfolio management, is going to just decrease that asymmetry. So it's almost like you need that as a characteristic. And he goes on to say, and it's just he's right in my wheelhouse, and I mean, I say the same things all the time, but I'm always trying to find
new ways of saying the same thing.
Yes. Hey, this guy actually agrees with me. So anyways, he goes, any investor that focuses on risk-adjusted return has their head screwed on wrong. Focus on compounded rate of return. If raising wealth over time ceases to be the goal, if people just don't want to lose money, just know it comes at a cost. And it makes me laugh because can you imagine going up to someone, an investor, and saying, a low net worth, high net worth guy, woman who sold their business and wants to, invest for the future and retirement. Hey, I don't know if raising your wealth over time should still be our goal. They'd say, what is wrong with you? And so at the same time, though, that I keep preaching, let your profits run means you've got to be not so concerned with volatility of open profits. And this is the way to wealth in taking those small losses. Another point he brings up is survival is essential. And so at the same time I look like I'm a wild man letting the profits run, I'm protecting my capital. I'm ready to do a cutback and reduce my positions and trade smaller for a while, this ultimate greatest rule of all time. But on a daily basis, no. On a constant, part of my system, no. I'm letting those profits run. But sometimes, February 2020, all hell breaks loose. Everything goes to one. The markets are going crazy. I'm having a big, huge drawdown. It's coming from every place, losing trades and winning trades. Okay, here's the one rule that always works. Cut your positions, 20%, 40%, 50%. Wait till the world gets back to a little bit more normal and go right back and continue trading your system. And that's the bottom line. This is a great rule because it does make further drawdowns less likely, but it also says, what do? I'm confused now. Well, you just keep doing the same thing, following your rules, but now we've adjusted once a year, once every couple of years, we're going to maybe run into these situations where we apply this money management rule, but not a daily basis of vol targeting and being very concerned about portfolio ups and downs and minimizing volatility and winning trades.
Yeah, no, completely take on your point there. I think one thing we have to try and understand then maybe why this is so difficult for most people to embrace and why they associate maybe higher volatility and even drawdowns with kind of the risk of total loss. I think it must go back to some degree that people are generally used to just being long only, meaning if you then look at your portfolio and things start to lose value and it loses 30, it loses 40%, the natural conclusion is if this continues, I'm going to lose all my money. I think the challenge is that people don't understand that that's not how we invest. That's not what our process looks like. And at some point, if the market continues down, that's actually a good thing for us. And also just the fact that we tend to focus on one thing, like the equity markets as being, if that goes down, that's a bad thing. But of course, generally speaking, and of course the news don't help in helping people to understand this, there could be so many other things going in a great direction from a trend following point of view that is just not related to the equity market. So I think I don't see any way that this is going to change. People will generally think that lower prices are bad and drawdowns, could continue forever. But I think it's because the process is not quite clear for people in terms of how our systems react to this, and also maybe from the fact that passive has become so dominant. Oh, just put some money in here and just sit and wait, do nothing.
Yeah, it's more of a marketing thing, and it's easy for people to understand. And it's a little sad when I read articles about diversification with commodities, and it's just going to always only commodities that can be included in your portfolio from a mainstream point of view are ones that have done well, buy and hold. So let's go back and check gold. Oh yeah, okay. As of today, gold has been profitable on a buy and hold basis. It may not be in the future, so you may not be able to include it. But trend following transforms gold into a positive expectation gain. But it also does with the grains and the currencies and the softs and the energy markets, crude. And so it's in order to get those markets, you must wrap them around trend following, and that return stream becomes quite a bit different. I know my shorts, I mean, how great are the shorts? Sometimes there's nothing going up, and sometimes the best hedge is to be, short some markets, long and short at the same time. But the shorts, you can't forget about how wonderful they are.
No. Let's move on to a tweet, another tweet. Again, this was related maybe to Derek, maybe a topic in his group, but also I think maybe Bruno C came up with some, at least he was referenced in the tweet. Do you know which one I'm talking about? When I apply trend following systems to the assets, their correlation over time over the full sample over selected rolling windows decreases, and I get more confident and relaxed to not take much care when selecting assets. Do you want to run with that?
I love that one. I mean, I think that last part is just kind of really funny because the rest of the investment world is going, what is wrong with you? You're going to be relaxed and not take much care when selecting assets. When I follow a lot of hedge funds and stock traders, and I look at their 13F positions quarterly, and most of these guys, they've got to find the best stocks, for, and they're not hitting the breakouts, taking small losses and hitting them again and, riding the trend, but they really do need to figure out ahead of time what's going to go up. And so we sort of say, oh no, with the trend following, and we do these back tests, we don't even need to get too specific on what part of our portfolio weighting needs to be commodities or energy or FX, Swiss and Euro are kind of correlated, so I need to have a precise weighting for each. Take that in consideration. I've done that. I've also done the back test and told my guys, hey, run the back test and trade everything the same size. Granted, we had about 20 or 30 markets in each in currencies, commodities, stocks, and bonds. We didn't overweight one sector. But those results, they would always come back and say, those are kind of like our best results. Just ignore everything and just trade each market pretty much the same size. And I think if you look at enough data and you have enough markets to where all the trades, are pretty small, and if you do overtrade energies a bit or too many currencies, it's not really going to pop up as something that's too horrible, then it's kind of comforting, And I think another thing that happens in there is, we were talking about correlated markets earlier, but even in the correlated markets, even your example of the Swiss and the Euro, the Swiss has had some amazing trends and outlier moves that did not happen in the Euro. I've mentioned silver doubled in 87, heating oil doubled a few times, 80, 84 and 90, and crude kind of sat there. And then they go back to being 90% correlated. So this is one of the kind of weird things about trend following. And one of the reasons that I like to trade a lot of markets is because I do overtrade crude, heating oil, unleaded, WTI, gas oil, but I trade each one of those so small that even doing that when it's wrong, which is most of the time, it doesn't really have much impact on my overall performance.
Yeah, I think you made another really good point, actually, which goes to this kind of just the bias we have as humans. And when you use the word precision, we love to be so precise. And with trend following, we don't have to be precise, which is something you would think people should embrace and would want to embrace. What's better than not having to be super precise and just get it, reasonably right and still have a profitable return stream over time. But yet it's like when they ask these analysts at the beginning of the year, so where do you think the Dow Jones is going to end the year? And they say, 37,859, right? I mean, instead of just saying, well, somewhere between 35 and 45,000, right? And they would be probably right. But we love to be precise, and it's just, I guess we are precise with certain things in our models, but a lot of things as you say, we take a much more relaxed approach.
Yeah, because when you look at all the data and you look at a long-term back test to get a good sample size of trades, it a lot of that stuff kind of washes out. And what you're left with is go with the trend and take small losses. Richard followed up on that tweet by saying, my many-year backtest concluded that there are sufficient degrees of uncorrelated relationships in WTI and Brent so that I can safely trade both. There will be many periods where they become uncorrelated. And I mean, you can't get more correlated than Brent and WTI probably. So that's pretty interesting. And then my comment was, these outlier trades, these things that happen that never happened before and we can never predict, they have nothing to do with what you've seen historically. And that is so hard to take. I mean, I was just thinking like last night of all these big trades I have on, and then all of these losers I have on. And then most of these trades, we do them, they just seem so insignificant because I'm just thinking, this thing's not going to go anywhere. I'm short milk or long rubber, and I'm thinking, this is not going to do anything. And you have to keep convincing yourself that this process, it does seem in hindsight that the vast majority of these trades are absolutely not worth doing and insignificant. But in order to get to those outliers, you have to treat them all. I keep telling myself sometime, what is your level of intensity on a random breakout? Well, you know what? It should be incredibly high. Like, oh my God, this could be one. And then observers would say, it's never one. Well, it's not never. It's almost never significant breakout. And I'm like, yeah, you're right. It's almost never, but not always. Right. And that's what makes all of our money.
It is so true, so true. The next tweet got me intrigued because I saw Jerry Seinfeld in it, and I immediately thought of George Costanza, and maybe we're now talking about doing the opposite, right? Don't buy low and sell high, buy high and sell low. But that's not where you were going. So why don't you take us into the world of Jerry Seinfeld and tell us how that fits into our world?
Yeah, I like this one as well. I thought it was really good. And once again, I can take almost any quote and just twist it into something that hopefully I can use to make a point. And so his quote here is, I think it's at the heart of system building. And it goes like this: if you're efficient, you're doing it the wrong way. The right way is the hard way. The show was successful because I micromanaged it. Every word, every line, every take, every edit, every casting. That's my way of life. When we first got to Chicago in 1983, one of the cliches was do the hard thing, do the right thing. And the right thing is going to be hard. And that's just your philosophy. So from now on, you can filter out ideas. Take profit, get out at the highs, buy the low, sell the high. Okay, that's taking losses and letting small profits turn into losses or small profits. That's hard. That's the hard thing to do, but it's the right thing to do. So I think in some ways, trend following, I don't think is very efficient, in any kind of measurement of our returns. It should not come out to be very efficient. You can't let profits run and have a high Sharpe. And you're not going to make the kind of money that you can make by taking small losses and going with the trend if you do that. So I love that. But then I got to thinking about something that you often bring up, and that is we like to give people some insights and rules about how we handle trend following. But for the vast majority of the people, they should default to putting their money with a professional CTA, because we do micromanage, and there is a lot more to just buying the breakouts and diversifying one entry, one exit, and a stop loss. Yeah, these are the basics, but I just feel like putting this together into this system that is going to take care of all the good times and the bad times. There's so many intricate parts to it that we have learned through backtesting or experience. And every word, every line, every take, every edit, this is how we approach building these systems. Philosophically, it's easy to explain, but it is like building a very complex building with a lot of moving parts. And it's not easy. And I am as good as I've ever been. And it's taken me 30 some years to get here. And I'll be better if I'm around in 10 or 20 years with these sort of seemingly minor details. But when you add them all up, they kind of matter.
Yeah, you can't backtest experience, that's for sure. And I like the point. And so my comments to that is the following. Yes, I mean, of course, we encourage people to dig into trend following and do the stuff and do the hard work, and also because we, at some point we hope that there will be the next generation of Jerrys out there and who will take the baton and build the next 50-year track record like Don has now and stuff like that. But that being said, for most people, you're absolutely right. It is better to divide their money and invest with some professional managers who have that attention to detail and the experience. The challenge I think there is that often I see trend following systems being sold to the public as easy, right? Or it's simple, easy, anyone can do it. Just buy my software, buy my rules, and you'll be fine. And that's the narrative. Now we're back to this thing about narrative. I mean, that's the narrative that often people want to hear, and they go and they have a bad experience and they leave the strategy forever because they didn't necessarily know all the intricate details that you have to be familiar with when it comes to this strategy.
And the amount of, at the same time I was getting the rules and the objective critical thinking and objective way of looking at things, I was also getting this amazing encouragement and support. It was not just a manual of rules, the Turtle Handbook. It was having your mentor and the creator and this genius people who created these systems, did these back tests, were superstars in math and strategy, saying, hey, if you lose money, that's okay, as long as you're following the systems. And just follow the rules, trade small. That's how you're going to be graded. And that's just a pretend way of life. Nowadays, if the clients said, well, look, if I could get out of this trade now, we may make more money, but it's breaking the rules. Someone would say, go break the rules. I don't care. And so it's like handing somebody a book saying, here's what it takes to be a Marine or a soccer player. Just read this book. Or going and participating and getting not just the training, but the mental part of the game, the emotional part. You're okay. You're a good person if you're losing money. And having that as a part of the rules, that is so important. And I think that, if you can't be in a turtle program, then, working for a fund like that, where you have these mentors who can see how trading really should be approached with rules and the benefits of the process and grading yourself on this process, then that's invaluable to becoming a good trader.
Yeah, and I think you made another good point, which I think is important to share, and that is, I think that all of us who jump on these podcasts every week, I mean, we actually learn something new as well. It's not like we are just sharing stuff that we already know. I mean, along the way, we learn from each other. We learn from the people around us, our peers, their articles, their insights, etc., etc. It really is something where we can safely say we are still students of trend following. It never stops. But what does help us is just 30 plus years of experience, and that's invaluable, and that's something that you can't do other than by doing it for 30 plus years, so to speak.
I've just gotten so much benefit from listening to Richard on the podcast and in the clubhouse and others. because some of these things you kind of know, you've maybe forgotten them a bit, but it does matter to even us and everybody. It doesn't even have obviously it doesn't have our experience, but even to people who have lots of experience, just the way that they can twist the phrase and get you to see a little insight, and it sits in your head a different way. Taking profits, outliers. Yeah, this has been a big re-education for me because I'd sort of lost track that was really my bottom line, is to catch these outlier trades and trade a lot of markets. And it's like I know that from day one, but I had sort of minimized that, and I was trying to be too precise with my portfolio weightings and all of these things that didn't really matter so much.
Yeah. Well, speaking of Rich, he's got a tweet that you brought also as something, and that was, I think, volatility schmolatility. Apply a rules-based process that enforces asymmetry into the process. And then there's like a chart of 3 different time frames with 3 different equity curves. But of course, the one that's really interesting is the one that is the longest, meaning when you apply this process for decades and not just for a few years, that's when you can really see the result.
Yeah, I thought this was a pretty good way of reminding ourselves that on a daily basis, we can see a lot of choppiness, and we talked about some of those profit give backs we've seen in these trends and losses we've been taking recently. And you get really focused. We're humans. We're going to get focused on the here and now. And looking at the daily charts can really, is a little discouraging sometimes. But the years, if we look at the year and how it's progressed, maybe the chart looks a little bit better. But looking at our equity over decades and the charts over decades, you see these great trends. There were no trouble. Just, I bet you back in the day when Jerry was looking at this trend 20 years ago, he probably didn't even care at all about what's going on these little down days. Oh, let me tell you, I cared. And we talked about this morning too. Rich said, I don't look at charts. Yeah. And I'm thinking, yeah, of course. I mean, you're committed to a strategy. It's systematic. You have your rules. You complain and you kind of like chime in when people talk about how hard it is and to stay disciplined and follow your rules. Yeah, because you're looking at the charts. You're looking at you're looking at your profit every day. I'm not saying don't ever, but part of the success in this business is, hey, look, if you really believe in rules and systems, then put yourself in a situation where someone else is going to do your trades. You're sending them the trades in the morning for them to do, and you're playing golf or thinking about other things about the market, but not the ups and downs of some of these trends that are going to tempt you to maybe override or not be disciplined or just have anxiety. This is like the greatest lifestyle ever, long-term trend following. It's profitable for one, and you have a lot of free time. And I spend my free time during the day just obsessing over finding markets. And, I've sort of exhausted my commodity futures and the futures market. So I'm kind of looking into stocks that, like I said earlier, that if I added them to the portfolio, that most of the time they would give me some meaningful diversification because they're weird, unique, or they're connected to maybe a commodity that I can't get my hands on in the futures markets.
Yeah, no, makes total sense. All right, we're going to pivot a little bit before we wrap up. I just wanted to, you were tweeting an article from Hedge Fund Journal regarding one of our peers, one of our very respected peers, Alpha Simplex. And I think actually it's Katie Kaminsky that they are talking to or had a discussion with for this article. And I only skimmed it. I know you probably read it much more than I did, but there are a few things that I thought maybe could be interesting to bring up as a talking point before we wrap up this week. One of the things, and I'm kind of, again, just from quickly skimming through the article, and this goes into some of the discussions we've had amongst us, actually, with Rob and Rich and Moritz and Mark, where we talk about this slightly difference between diversifying across time frames, but essentially using the same type of trend following model, And then what I think they're doing, and others are doing as well, of course, is where they allocate to a number of different types of models. There is something about here, they write, the capital allocated to the adaptive models has grown over time as we have gained confidence out of sample. This is a key differentiator, as is robustifying allocations between the models. Machine learning and nonlinear techniques have been used from the start and have steadily expanded to a 40% allocation, embracing broader and more complex approaches and techniques. The nonlinear techniques include kernel regression, scenario-based analysis, and random forest. So those are definitely different types of trend following things than most people are familiar with. So that is, I mean, how do you look at that? How do you look at the debate between should we do trend following using different methods, or should we do trend following using the same method, but obviously, like most people would do in any event, just allow the difference really to be the kind of the speed or the time look back period that we apply?
Yeah, well,
and by the way, Jerry, sorry to interrupt you here before you even get started. That's very rude of me, actually. But I heard you say, I think it was last week, but where you discussed this with a few of your friends at Clubhouse, where you talked about you had tried to apply shorter term models, but they detract from your performance. Remember that conversation?
Yes.
Okay. So I sat there listening and I thought, well, hang on. Maybe this is just a result of the fact that short-term trend following doesn't work very well. So when you look at those who are successful in the short-term space, they don't do trend following like you and I know it. They do some kind of momentum trading or something that might take a breakout, but might get out at a time stop rather than wait for the market to go in. So my point was, yeah, well, maybe we do want the shorter term trading in our portfolio to dampen some of those drawdowns, but we need to think about short term differently than just applying the same methodologies with shorter term timeframes. We need to develop models that does work and does make money over time, in the short term space. So I just wanted to remember to bring that up with you as well.
No, that's a good point. I agree. I just think it's hard. It's harder.
Sure.
And, but to me, it's just going to all come back to this one idea, which is sample size. And if you get out there to the meat of what works, these longer term breakouts, then everything works, and it works about the same. And then if you trade too short term, that doesn't work as well. So you're right, you've got to do something different. But how different, if it's different, is it still right? And one entry, one exit, and a stop loss, I know that's right, but that doesn't work that well in the short term stuff. So I don't think that I would approve of, I laugh because, who am I to approve of anything, but I couldn't get this by my sample size filters, this idea of a time stop. I don't think that's something I could do. I don't think that's right. I'd have to run it by the math guys, but I'm pretty sure I could not do that. And so I think that's where the rubber meets the road, is that I'm not smart enough to come up with it, but if you come up with it, I'll probably criticize it. So I'll probably say it's not. And as you've said many times, though, how hard is it, and how inconsistent are those guys who try to get into this short-term space where there would be so much more competition because the drawdowns are smaller. I can make the same amount of money as Jerry with a lot less drawdown. Well, I mean, that's going to attract a lot of smart people. And they also talk about these shorter-term methods. They have a time window. They work for a while, then we find another one. And so, or you can just keep doing the long-term trend following. I'm like, okay, I raised my hand on that one. I'll just keep doing that one.
Yeah, but it kind of ties into what Katie says in this article about, at least from their perspective, it sounds like that they have embraced a lot more different types of trend following and all sorts of from machine learning and stuff like that. So there's no doubt that the way classical trend following has where it's evolved from is that there's a lot of creative freedom in that space, which is important for people to understand because it also explains the difference in performance from time to time.
I think I was a little surprised and perplexed I think they mentioned the word simple and then classic. And I was like, and then they mentioned words that I had no idea what they meant. And so we talked about this on Clubhouse, and a lot of the smart guys on Clubhouse, they didn't understand these words either. To some degree, I think that you could raise a lot more money if the majority of your performance does not betray trend following, but you can wrap it into these other ways of doing things and know those words and speak that really good language. Your AUM is going to be, look at it. Who has all the AUM? It was another article that I tweeted a while back about a firm, very big, famous, a lot of smart guys in Europe, and they closed down this fund that was their first attempt or recent attempt at machine learning. And it's an article, and I tweeted it, and it goes like this. What was happening with the machine learning is sometimes it was too correlated to the trend models. And they said, to account for this and minimize this potential correlation, we decided to introduce penalties in the portfolio process. Ultimately, this decision proved very costly during this recent period. So in other words, if we come up with these ideas, there are going to be periods where trend is going to really do a lot better. February of last year, where classic trend hitting the breakouts was the only thing that's going to work. The quicker, the better. And so if you let these fancier type models with these shorter term and machine learning and AI, they do have this potential to really underperform because they're learning when trend following is not learning. All trend following knows is this breakout works, that breakout exit works, but everything else is not going to look like the past. Well, these other methods are like, no, we will look like the past, and we're learning. The more past we see and participate in, the better we're going to get. However, it doesn't really work out that way. So it's dangerous to try to get it to not include trend, in some of these models, because that to me is the real big learning piece, is that sometimes you can't predict and trend is going to do you right. And missing this trend, it's everything. How many times have I looked at, well, how can I improve this entry? How can I have fewer losses? What should my unit size be? 0.1 or 0.12? And then the markets take off and you get these outlier moves. You're like, oh yeah, I guess that's what's important. And all of the people around me who don't pay attention to anything, they did the same thing. They got onto the soybeans and corn and lumber, and they made as much as I did. And all these pretend differences we all have, they all fall aside when the big thing happens, which is the markets take off.
Yeah, no, absolutely. It's so important. I don't know if there was anything you took away from that you wanted to bring up from the article. One thing that I noticed, that there was a little bit of a paragraph about macroeconomic climate for trend following. And they write in the article, they say the research predates the near 40-year bond bull market and low inflation regime that began in 1981, and considers how trend following strategies might have fared not just in the 1960s and the 1970s, but also in the previous centuries. And they say historical analysis of trend followers over the centuries suggest that they would have performed better under inflationary climates. We actually recently did also some research on our side, because we go back to the 1974 in terms of actual trading. So we have actually traded through inflationary periods at Dunn. And we also did some work in terms of applying our current models back then without it. So including all the improvements we've done over time. And actually, that's really fascinating to see. And generally, I would agree with their conclusion that even our current models would have performed better during those inflationary times. But actually, generally speaking, of course, because that's what the improvements is all about, is that they would perform better generally speaking, but including inflationary periods. So I'm kind of cheering for a little bit of inflation, not necessarily hyperinflation, but But it would be nice if it kind of gives a little bit of more, as I talked about before, more freedom, more divergence in the markets, because that's really what our type of style of trading, trend following, likes. And I think that's what they confirmed in their long-term data set, Katie and Alex, when they did their book.
Yeah, long commodities, man, you just can't beat it. I mean, we're going to see these kind of trades in the currencies. And I guess we did have some big trends in the bonds, but I just wonder sometimes, but I'm still committed. I'm still committed to trading all these markets. But those commodities are so much fun. And I really have no interest in looking back and trying to see how we've done in certain regimes, or certainly not trying to predict these regimes. I feel bad for people because now it's a lot of comments and articles and Twitter about inflation and commodities and supply chain. Well, we hit those breakouts a year ago or longer without any of that talk. There was no regime.
Right.
That regime, at the same time regime talk picked up, we were making lots of money. So it's just a dangerous way of looking at, it's always nothing's going to be gained really by modifying your approach with anything other than, your rules, your price-based rules on entries and exits.
Yeah, no, absolutely. Now, before we wrap up, let me quickly inform you about how performance looks like. Obviously, these are a day early, so Wednesday evening numbers, but still up a little bit for the BTOP 50 index for the month of November, up almost 12% for the year. SocGen CT index also up 16 basis points for the month, up 10% for the year, and the trend index up 18 basis points in November, up 14.15% so far this year. And the short-term traders index up almost 1% this month, up 3% for the year. My trend barometer is weakish at the moment, so 34, so it kind of ties in with a bit of a flat month at the moment. Equity is still strong, up almost 20% now on the MSCI World Index, and even bonds, the World Government Bond Index is up this month. We're going to wrap up this conversation. As mentioned before, we recorded it a day early, but hopefully there won't be any major things we're going to miss out. Next week, I will be joined by Mark, so keep your questions coming, and you can email them to info@toptradersunplugged.com, and we'll do our best to get them out there. We'll be trying to put together as mentioned before, the whole team of the Systematic Investor team here. We'll try and get a recording done where we can all join. So if you have questions, just start sending them in, and maybe we can have like a mega year-end trend following session that will be fun, and we can hear debates between Jerry and Rob and Moritz and Mark and myself. So I think that could be great. I just need to make sure I can line up everyone at the same time. But anyways, as always, thank you so much for listening from Jerry and me. Until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.